Okay, guys, welcome back to the channel. So today we're going to get into some of the nitty gritty on what it's like to be a loan officer. So this is a career that I've had for 16 years. My dad was in the mortgage business. That's how I got into it. It's an incredible business to be in. It's really tough. This is a really tough job. It can be very stressful. But there's great opportunity with it as well. And with that opportunity, comes a lot of responsibility. Like you're dealing with people at a time when they're making the biggest financial transaction generally of their lives. And so that's a very, emotional and can be stressful time for people. And so because of that, emotion and stress, when things aren't going well, it can be really difficult. And when things are going well, then it's amazing and everybody's on cloud nine. But because it's so difficult to do, there's a lot of really great opportunity to build a mortgage practice. There's incredible income opportunity. There's the ability to really be an entrepreneur. And you're doing something that matters to people. I think that's why I've stayed in the business for as long as I have is I'm a part of someone's life when they're making one of the biggest financial transactions of their life. So when I call, like that's an important call for them. When I first got out of college, I had a job at a restaurant for a handful of months, and then I got a job with a larger financial institution, and I was selling subprime refinances, high interest rate credit cards, high interest rate auto loans, and personal lines of credit. And we were selling products to people that they didn't really need. And it just felt like icky. Like I just didn't feel good about doing it. And nobody wanted to talk to us. We were hounding them and cold calling them. And there was no real value there. We were just selling people products they didn't really need because we were trying to hit numbers. And that just didn't feel good to me. And I lasted like a year in that. I sucked at it. And they got in the mortgage business. And then now I'm helping people buy their dream home. I'm helping somebody buy that first home or refinance their mortgage and save $500 a month. And it really matters to them. And so to be a part of that, that's the thing I love about it most. And that's what gets me through the most difficult times. So thinking about the mortgage industry and like, what is it like to be a loan officer? Well, there's several different structures of companies that you could be in as a loan officer. So the first would be working at a depository bank. So your regular banks, Wells, Chase, whatever. At a big bank or even a mid-sized bank or credit union, generally the setup, and this is how I started my career, the setup is you're covering a bank branch and you're dealing with the walk-in traffic that comes in through that bank. And so the personal bankers are sending you clients. You've got clients who are, regular customers of the bank who will just walk in to do a loan with you. So you get business fed to you. You don't have to go out and build your own book. So that's very helpful. But in exchange for that, the bank takes a huge percentage of the commission. They take like 2/3 of the commission because they're feeding you all of the business. And with the banks and credit unions, a lot of them, they have dozens and dozens of streams of income and lines of business. Like the big bank I was at the time I was there, the mortgage department was one of 84 different lines of business. So they did mortgage lending simply to keep their clients within their sphere. Like they don't want their best clients going down the street to a competitor bank to get a mortgage because they don't offer a mortgage. And then now they're in that bank branch and the bankers are cross-selling them on moving their checking and investments over. And now they're losing this whole relationship with this client. So banks, they aren't in the mortgage business to like turn a profit with mortgage lending. They're in the mortgage business to keep their book of clients within their sphere and not let them go to their competitors. So because of that, the banks don't put the resources, generally speaking, into mortgage lending that a mortgage company would. And it's more difficult to provide a good experience for clients when you're working at a big institution like that because they're dealing with such a high volume and they're doing it, at as low of a cost as they can. So that's a depository bank. Independent mortgage banks. So that's like the company that I'm at. So an independent mortgage banker, all they do is mortgage lending for the most part. So they're considered a bank, a mortgage bank, but they don't have depository accounts like checking or savings or, insurance products or investments or car loans or anything like that. It's all generally residential mortgages, and that's all that they do. And so at an independent mortgage banker, one of the advantages is because that's all that they do, they focus 100% of their resources on processing and approving loans and the products that they can offer and the systems that they have. Generally, everything is done in-house. So same thing as a depository bank, like the company I'm at, Cross Country Mortgage, all of our underwriting, processing, disclosures, docs, funding, it's all done in-house with Cross Country Mortgage. So we have control over the whole process. Same thing at a depository bank, they would do all of that in-house as well. So you're working in-house. And at an independent mortgage bank like I'm at, you don't get fed any business. You've got to build your own book of business. So when you're working on this side of the industry, you have to be able to go out and make relationships, develop referral sources, make connections with people who can get you in touch with others who need a mortgage, and then develop those relationships and lead sources over time. So you're building your own clientele, you're building your own following. In exchange for that, you're getting a lot higher percentage of the commission and the revenue that comes in on those deals. So way more money per transaction, but you've got to be able to do sales. Mortgage brokers is similar in the fact that you're generally building your own book of business. Like some brokers pay for online leads and get leads coming in through the internet, different sites like bankrate.com and that type of thing. So there's some ability to pay for that, but then you've got a overhead cost to generate leads. So it's generally you're building your own book of business. A mortgage broker, the difference there is that you're taking an application and then sending that to a different financial institution to do the underwriting and the docs and the funding and the disclosures and all of that process. So you're the middleman or middlewoman taking that application and then sending it out to different lenders that would fit your client's need. And you're handling kind of the front end communication for the client. So, it gives you some good opportunity to shop around different lenders. There's some advantage there. At times, depending on how the market goes, brokers can have some advantages with rates, but that ebbs and flows. And then mortgage brokers, don't have a lot of control over the process, but it is very entrepreneurial because in a lot of cases, if you are your own mortgage broker, you're self-employed. Or some mortgage brokerages are big enough where you could go over and be an employee of the brokerage, but then you're still working very independently. The last way you could structure, or the last type of company structure that you could be a part of is working at like a call center. So this would be like a Rocket Mortgage or some online lenders that are out there that are just a call center environment. So these lenders, the lender at the company level generates all the leads. So similar to the bank, you're not generating any leads when you're at a call center. So you're getting business fed to you, but you're earning a much smaller percentage of the revenue of those transactions that you're closing, and you've got to do a high volume. And at a call center, you're very micromanaged. Like it's very regimented. You're on the clock for a certain amount of time. You got to take a certain number of dials. You're on an auto dialer. So, depending on the company culture, it can be a lot of hours, and because you can do a high volume, you can make some decent money, but you're working for a much lower percentage of the revenue. So it's a lot more work for less money, but you don't have to go out and build your own book. But at the same time, when you're at a depository bank or a mortgage or a call center, because you don't have a book of business, you don't carry a lot of value in the industry, because if you leave that company, you don't have any business coming in. Whereas like me, I've built a following and a book of business and clientele who refer me and trust me to do their mortgage transaction for them. If I leave and go to another company, most of them are going to follow me and work with me on their future transactions. Whereas at a depository bank or a call center, you don't get that. So that's the different structures that are out there. Now, the call center and the depository bank, that can be a good place to learn the business because you're getting leads fed to you. So you get a lot of at-bats to learn how the process works and what people are looking for and talk to clients, and you don't have the pressure of also having to build your own book at the same time. So it's a good way to cut your teeth and learn the business. But ultimately, like to build a big career out of it and to have the biggest opportunity with it, I believe you need to be with a independent mortgage banker like I am, or as a broker, as a mortgage broker. Those are the two places to be if you really want to do well in this space. So the ideal, if you were new coming into the business, would be to go to an independent mortgage banker or go to a mortgage brokerage where you could join someone's team as like a junior loan officer or an assistant and be on a salary and have that opportunity to learn the business. And then once you've learned the business, now you can branch off, become your own loan officer, and focus 100% of your time on generating business, not having the pressure of also having to learn how to do the business. Because to learn how to do the business and to go get the business at the same time is really difficult to do. So I spent the first 7.5 years of my career at a large bank and then went to the independent mortgage banking world. I think that was way too long in hindsight. I would have been there for 1 or 2 years and then made that jump. But there's a lot of stuff that I learned. My dad worked at the bank that I was at, so we had that connection there, and that was really special to share that over that period of time. Even though we were in different states, he was a bigwig, and I got to pick his brain on different things, and to have a regional manager on the other end of the phone who's your dad was pretty cool, and he was my first mentor in the business. So there was a lot of value there for me being in the bank at that time. Mortgage industry, several of these positions, a lot of the depository bank positions, all of the independent mortgage banker positions, all of the mortgage broker positions are 100% commission. So even if you're an employee of the company, like I'm an employee of Cross Country Mortgage, but I'm paid 100% commission. You're depending on yourself to bring in deals. And if you're not bringing in deals, you're not making money. You get a small draw, but it's a recoverable draw. So you have to earn enough commission to cover that draw. Otherwise, it's rolling over negative month over month. So you've got to be able to generate business. You're dependent on yourself 100% to set your income. So that can be the scary part for most people. But that's where the people who are really motivated have the most opportunity, because when you're 100% commission, it also means that you have an opportunity for unlimited income. I mean, literally unlimited income. Like you could get to just a ridiculous level in this industry if you're willing to learn and put in the work and grind it out to get to that space. It just depends on how bad you want it. So you're betting on yourself. How well can I do versus betting on someone else, a company, to take care of you. So at a call center environment, like those loan officers are generally on some kind of salary plus commission. So there's more stability there, which tends to attract some people who are worried about having to build their own book. I like to take some risk, and I also have massive goals, and I believe that I can figure out how to get it done. And so I've always been 100% commission. I've been 100% commission for 16 years, and there have definitely been some ups and downs during that period of time. Especially, first 10 years, really, I was in the business. I didn't understand, and I didn't learn like the importance of saving liquid cash. Like I saved into my retirement accounts, but I didn't save enough liquid money. And our business goes through all kinds of cycles based on what the market is doing. And so I would go through these boom cycles where we're closing a ton of loans. I'd start adjusting my lifestyle, spend. I'd pay down credit cards, maybe pay off a car loan, and I'd have very little debt, but I also wouldn't have nearly enough cash savings in the bank. So then when the market turned, which happens like that, I mean, it's crazy how fast it'll happen. All of a sudden I'm racking up debt because I don't have enough cash to see myself through. So you have to learn how to save cash when times are good, and then have that to fall back on when times are more difficult. Like right now, we're in a really difficult cycle of the market. I think this is the most difficult cycle of the market I've been in 16 years. But my wife and I have saved a lot of cash over the last couple of years, and so we have that as reserves to tap into when needed. So super important, being 100% commission, that you have that you can fall back on, because this industry is very cyclical. But betting on yourself, that's how I think you do it. That's how you can get to the highest levels. If you have big dreams and goals, you've got to put in the work, but you're betting on yourself to make it happen, and there's incredible opportunity. So if you're an independent mortgage banker or broker and you're building your own book of business, where do you get the business? Well, you can get it from your personal network. So you're just your sphere of influence, everybody that you know, friends, family, former coworkers, neighbors, people you meet at kids' sports, all that kind of stuff. You're always networking. You're always building relationships with people. And you're not always just constantly asking like, oh, do you need a mortgage? Do you need a mortgage? Like that comes off the wrong way. But what you're doing is you're making relationships with everybody that you can. And the more people who know what you do, then if they know, like, and trust you when there's a need for them or a need for somebody that they know, then they're likely to look your way for a mortgage. Real estate agents. We love real estate agents in the mortgage business. They're our biggest referral source. Real estate agents, they need a lender they can depend on to get deals done on time and accurately. They also need a lender who can provide a great experience for their clients, because real estate agents, just like mortgage lenders, they're 100% commission and they're self-employed. And the best way to exponentially grow your business is to provide a great experience for your clients from A to Z. And now that client is out selling you to all their friends and family and coworkers and referring you after the transaction. They're also coming back to you when they need to refinance or when they purchase a second home or move up purchase for their primary residence. So having a good experience for the client is absolutely crucial for realtors and lenders. And once that file goes under contract, the realtors are really dependent on the lender to perform and provide that experience, because basically ball's in lender's court to get it through from initial contract to closing. So mortgage lenders play a crucial role in that process, and that's why realtors need to have good lenders in their pocket who they can refer their clients to. Building relationships with other business people, like financial advisors. Financial advisors are constantly recommending other business professionals to their book of business, because they're really, like the real estate agent. The real estate agent is like the quarterback in the real estate transaction. Financial advisors like the quarterback of their client's financial profile, of their client's financial life. So clients of financial advisors typically heavily lean on them for recommendations of other financial services professionals, other business professionals to help them in other areas, mortgage being one of those. So if you have good relationships with financial advisors, you can get referrals that way. CPAs, family law attorneys for divorce situations, life insurance agents, all of these people are great referral sources because they're in contact with people who are doing financial transactions that are loosely related to real estate, and they're working with people who generally have some money so they can afford to buy real estate. So making relationships with all of these people is an excellent way to get referrals. You're building a personal brand. That's something that I've dove head into here in 2022. I think it's the way of the future. Social media is being used more than ever before. The average American who is an internet user is spending 2 hours and 20 minutes a day on social media, which is a staggering number. And so if you're not there building your personal brand, you are not in front of your clientele. That's where so many people spend their time these days. And the better your brand is through social, the more you're going to attract other people through those platforms. So personal brand, absolutely crucial in today's world. Builders. So every builder needs a preferred lender for the same reason that real estate agents do. They need a lender they can depend on to get the transaction closed. Build times are typically very long. Builders invested a lot of cost into the build of the home. If they have that deal fall through at the end because of financing, it's extremely expensive. So builders need strong lenders who that they can depend on. And then the last and I would say lowest on the totem pole would be online leads. Online leads you can purchase on various websites. The challenge with online leads is there's no relationship there and there's no trust that's been built there. When you get referred by someone, whether it be a builder, a friend, a realtor, a financial advisor, someone that client knows and trusts is recommending you as someone that they know and trust. And so you're a lot more likely to close a transaction for someone when there's that inherent trust that's been built in with a referral. So online leads, you're paying for it, and you're also trying to develop and establish trust, and you're typically competing against 4 or 5 other lenders right off the bat. So it's a really tough way to go, but some loan officers have made a very successful career out of that. What does the daily life look like for a loan officer? So it's super busy, because as an LO, you're dealing with clients, helping them submit an application, so you're having an initial conversation with them to do basic needs analysis, find out what they're looking to do, what their goals are. You're helping them to submit an application, giving them a list of all the paperwork that's needed. When that paperwork comes in, it's all got to be reviewed. Income and assets have to be calculated. Numbers have to be run to see if they qualify for a mortgage. You have to know how to review credit reports. You have to be very well versed in all the different types of financial instruments that people have and the documentation that goes along with that. How to read divorce decrees, how to read credit reports, how to read bankruptcy paperwork, all different kinds of asset classes. There's a lot that goes into it with finances because you're dealing with almost every element of people's financial profile. So you're taking in a lot of paperwork and reviewing it and then recommending products for clients. And then once they go under contract, now you've got to communicate with them and guide them through that underwriting process. And there's so many steps that go through with that. Updating paperwork. The loan comes out of underwriting. Generally, more paperwork is requested. We've got to order an appraisal. And then when that appraisal comes in, you've got to be able to take the client through that appraisal and explain what that appraisal is, what the value is, how it worked. And then you've got to be the liaison working between them and the underwriting team to put together all the paperwork that's needed to approve the loan. So that's a 30-day process that you're with those clients, and there's tons of communication that's needed throughout every step of that process. So that's a big part of the day. When you're running your own book of business, you've got to spend a lot of time prospecting for new business. That's got to be 50% of every day because you're constantly looking for new leads and referral sources so you can do more deals for clients and grow your book. The average client turns over every 3 to 7 years. So we're, kind of transactional in the sense that we're not doing loans for our clients every single year. It's every few years. So we've constantly got to be filling our pipeline with new clients because we don't have a high rate of turnover with every client that we do a transaction for. So you're spending a lot of time networking and prospecting to build relationships with the groups that I mentioned earlier, and then continue to nurture those relationships. And then marketing to your past clients. So putting out content through social media. I send a newsletter to all of our past clients every other month. So I've got to write that newsletter and come up with the content for that. Following up with people to do an annual client review call and see how things are going for them in their house and if any of their family needs have changed. Checking in with people on their birthdays. Doing online type of marketing with some different email campaigns we have in place, text campaigns. So there's a lot that goes into building out a system to stay in touch with your past client database because that can be an incredible source of referrals. Client events. We do 1 to 2 client events every year so that we can get in front of our best clients, see them face to face, see their families, see how they're doing, and keep that relationship going. So all of those events and different marketing activities take time and money to execute and run every single month and every single year. So tons of time spent with marketing. And then I meet with every client that we do a pre-approval for. I meet over Zoom. It's between a 30 to 60-minute meeting. So I've typically got 1 to 2 of those every day. I schedule those generally in the afternoon. And then I'm meeting face-to-face with the different referral partners I have who refer me their clients, financial advisors and real estate agents and CPAs. And a lot of those look like breakfast meetings or lunch meetings or coffee. So you add in time on the phone with existing and new clients, face-to-face and Zoom meetings with prospective clients and referral partners, developing and running the different marketing systems that you have. And then as you build to a higher level, what you can do is add staff and build a team to help you with a lot of these different activities and components of the business that need to be done so that you can then leverage your time to be able to go get more business. So I've got 5 people on my team and I've created systems and processes for all these various components of the business. And my team helps me to execute on all these different components, which frees me up with more time to spend on marketing and lead generation. So if you can hire one person and say that saves you 25% of your time, if you take that 20% out of that 25 and allocate it toward more prospecting and lead generation, then you will grow your business. But the bigger your team gets, I've got 5 people on my team. Now part of your day becomes working with your team, helping your team, coaching your team, mentoring your team, and managing what they're doing. You're involved more in high level issues and problems that come up. So there's a lot of different hats that you're wearing as a loan officer, especially as you start to build out a team. Now you've almost got like a small business. But that scaling process and adding the new team members is probably the part that I enjoy the most out of the business. I love having a team. I've worked as a solo loan officer for 11 and a half years. And it's way better to have other people in the trenches with you. And especially in my team, we've all been together for at least a couple of years. My processor, she's been with me for almost 6. And so you get to share the wins. You've also got somebody to cry with you and the losses. And there's a lot of stressful transactions. And so having someone else in the trenches with you who knows what you're going through, I appreciate that so much. So it makes the business a lot more enjoyable. So having that team to get to the higher levels of production, like I've been fortunate to be top 0.25% of LOs nationwide, top 0.5% of LOs nationwide. You can't do that without a strong team behind you. And there's just too much in the business to get done. And so having that really solid team in place allows you to continue prospecting and continue building the business. And then, the last thing that loan officers go through is big fluctuations in the market. So our industry can be heavily impacted by what's happening with financial markets. Like we take the last 2.5 years, COVID, that was an economic crisis. It's a health crisis that led to an economic crisis. And generally in economic crises, interest rates go down. Well, when interest rates go down, people want to refinance their mortgage to save money. So when we hit COVID, we were very fortunate to be one of the industries that significantly benefited from COVID. I call 2020 and 2021 mortgage Disneyland because we were absolutely slammed with clients. Like as soon as the rates went down, our phone was ringing off the hook. And so that's all of our past clients coming back to us to do another transaction to lower their interest rate and save money. It's referral partners referring us new clients who are asking who should they go to do a refinance. And so we're able to capture a ton of that business because we've done a good job, my team, of staying in touch with all of our past clients, and we provided a good experience for most of them getting their mortgage. So we've built that trust, and then we've stayed in touch so that when an event like that happens, we're there and we're the first person that they think of. So we have years like that are an incredible boom and incredible opportunity. And then now, here we are, first quarter of 2022, and it's basically the opposite. I've been in the business for 16 years. I'd say this is the toughest market I've ever been in. We have very little inventory, not anywhere near the number of homes that we need on the market to have a balanced market. So there's fewer purchase transactions being done, and it's much more difficult for our clients to get an accepted offer because it's so competitive. So like I'm getting the number of referrals that I need to hit my goals, and I'm doing the number of applications that I need to hit my goals, but I'm not hitting my goals from a production perspective because the conversion is lower, because the market is so tough. And then we've got interest rates rising, which as rates rise, there's no need for anyone to refinance their mortgage. Okay, well, I shouldn't say no need. There's much less need for people to refinance their mortgage. Generally, people refinance to get a lower rate. The other reasons people would refinance is to take equity out of the home, to remodel or do improvements to the home. There could be divorce situations where one spouse is refinancing the other off of the loan, and then people could be refinancing to get out of an adjustable rate mortgage. So those are some of the non-interest rate driven reasons to refinance. But generally speaking, people refinance when rates are down. When rates are rising, there's almost no refinance business being done. So if your business is 40% refinance, there goes 40% of your production right off the bat just due to rates. So we have very little inventory, and we have interest rates rising and almost no refinance business. And so it's a really tough market. So now we're switching gears, and everybody's got to retool, and they've got to go after new referral sources. They've got to recalibrate their business to be successful going forward. And the ones who don't adapt and change will go out of the business. When we go through this part of the cycle, like there are some lenders, loan officers, and companies that are 90% refinance. They have lost 90% of their business in this market cycle. So it's very important getting into this industry that you're a purchase-focused lender. If the majority of your business is purchase business, then when refis dry up, you lose some of your business, but you don't lose the majority of your business. So that's just a high level on some of the things that I go through as a loan officer and what this industry looks like. It's an incredible industry. I'd be happy to talk to anybody about it who had any interest. The opportunity is amazing.